This is almost like an emergency video that I created because over the weekend, Fed has triggered the recession. Why is that so? I'll explain to you in this video and what we need to do right now before the recession comes. Should we sell all our stocks? That may not be a totally bad idea to sell some of them. And let me explain to you why. Now, over the weekend, we know that the Fed chairman has spoken and he said the time has come for Fed to slash interest rate. So the stocks, they are ready to shoot up. But however, guys, I need to understand a few things. And let me explain to you first that in the long run, I believe that the stock market is going up due to inflation, due to economic progress. And in the long run, when we buy, we hold, we will make money. That's my strong belief. And it's been proven years after years, decades after decades. However, wouldn't it be nice to miss out those big dips where it's hit by recession? Wouldn't you want to actually avoid them or even make money during them instead of just buying and holding the stocks blindly? Now, again, it's not a bad idea to buy and hold, but if you want to be a more sophisticated, a better investor, these are some of the things I'm going to share this particular video. So do take note. What happened is when interest rate is being slashed. Now, why is that happening? It's because CPI, meaning you say inflation, is slowing down. So when inflation is slowing down, the Fed chairman says that, okay, it's time to actually cut interest rate. But let me share with you, there are still some very concerning economic data. The first economic data is the yield curve. I need you to understand that the yield curve historically has correctly predicted, or it's an indicator to show that recession is coming. And how accurate is it? The inverted yield curve is 100% accurate. Now, let me explain to you very quickly in case you don't understand about the yield curve, is this. Now, the yield curve, generally speaking, logically speaking, when you put your money in the bank for 10 years versus, let's say, 2 years, you expect, if you put your money longer term in the bank, you are getting a higher interest rate. Does it make sense? Okay. Now, if you put in there for 2 years, well, you get a lower interest rate, that's fine. Now, but right now, the 10 years interest rate yield is lesser than the 2 years. Can you see that? It's lesser. Now, these two, the 10 years versus the 2 years, is what is commonly viewed as the yield curve. So when 10 years is lesser than 2 years, it's called an inverted yield curve or a negative yield curve. And let me share with you, yes, this is the data we have right now. Let me share with you that the yield curve has been negative for very long. So 10 years, the yield has been lesser than 2 years yield. Now, why does that actually matter to us? Is because, again, we use data to measure. Can you see that every single time when it's negative, when it's a negative portion and they rebound back to positive, a recession will come. Again here, a negative portion, 10 years lesser than 2 years. When it becomes positive again, the recession will come. It has happened over and over again, 100% of the time. 100%. What is the reason behind that? What's the logic behind that? Well, we can actually dive in more in depth, but however, when the indicator is 100%, you better take note of it. And can you see right now, this is the current yield curve. It has been negative and it's slowly converging. And if you look at the latest news based on Fed, they say that they're going to cut interest rate. What happened was the 10-year yield curve or the interest rate for 10 years has increased while the 2 years decrease. You can see them converging. Can you see converging? And when it converges, right, it means that inevitably this yield curve is going to become positive again. And when it becomes positive, you can expect a recession. Oh, by the way, the gray area shows all the recession. So what if there's a recession? I'll show you so what. Now, this is the first concerning point. The second concerning point, besides the yield curve, is unemployment rate. Now, unemployment rate is not as bad as people expect. That doesn't mean that it's not bad. So unemployment rate indeed is going up. Can you see this is real data? It's no longer about expectations. Well, the stock market actually went up because people expected worse unemployment rate or they expected like a certain unemployment rate and it hits the expectation does not mean that it's good. Okay, so I expect you to like be overweight, I expect you to be unhealthy. And when I check your health check, yes, indeed, you're unhealthy. It's still unhealthy. It is still unhealthy. So it's extremely mind-blowing that the market didn't read it that way. But let me share with you, if you look at the unemployment rate in the US, it is creeping up. And let's look at what happens in each unemployment rate high. Okay, when it's high, when a lot of people are unemployed, what happens? Can you see each time when unemployment rate spikes up, okay, you see when it's going down, and it spikes up just a little bit, spikes up. Just a little bit of spiking up will cause an a recession, and the recession will create even more unemployment. So it's only the beginning. Can you see? Unemployment rate goes down. Okay, this one is due to COVID, a bit unnatural, but unemployment rate went down after COVID. And can you see it's creeping up? Every time it creeps up, the recession will come. The recession comes. So guys, I'm pretty concerned about this. I think that inevitably the recession may be coming. Oh, that's why the Fed is cutting interest rate. Because the theory is this: when we cut interest rate, okay, when interest rate goes down, what happens is a lot of companies, they can borrow more money, they get more access to capital, and that's where they can expand their business, and that's where they can push unemployment down. This is the theory, right? So that's why with a cut in interest rate, unemployment should go down, and that's where we can avoid a recession. But guys, let me show you something that may blow your mind, which is the next curve. Now, the next graph, you can see this is the Fed fund effective rates, which is the interest rate versus unemployment rate. I got a bad news to show you guys, and this again is by data. The logic, we are going to discuss it in subsequent videos, but let me show you this. So the red color line is the Fed rates. Can you see every time when the Fed reduces rate, this blue line goes up? And what is this blue line? Can you see? It's unemployment rate. It's unemployment rate. So again, every time the interest rate goes up, and then when it comes down, see, when it comes down, can you see again here, when it goes down, the blue line goes up. Again, when the interest rate goes down, the blue line goes up. So data has shown over and over again, every time when interest rate is cut, again here, look at here, the latest one, when it's cut, unemployment rate goes up. And when unemployment rate goes up, it enters a recession. Now, the theory is it because the interest rate actually affected unemployment rate? Well, logically, it doesn't make sense. It doesn't behave that way. But however, maybe a lot of times the interest rate is cut a little bit too late. Unemployment is already creeping up. When interest rate is cut, it doesn't help to have the soft landing that they reach. Okay, so Fed has been talking about a lot about soft landing. It may not happen. And based on history, you can take a look at this graph. It had never happened. It almost never happened. Every time interest rate is cut, unemployment increases, recession is triggered, and the whole entire stock market, what happens? Let me show you this. Okay, so this is the stock market. In the long run, it's still going up, but let's look at sector by sector, or rather segment by segment, every, I would say, 10 years or so. Now, again, you can see the gray portions will be the, what do you call it? The gray portions is the recession. Can you see? 2008, we all know this. Recession comes, the stock market goes down. Let's go a little bit further down. Okay, 2020, this one is by COVID. Same thing, when recession hit, stock market goes down. This is the NASDAQ Composite Index. Let's go a little bit further back, okay, to check whether it happens in the past. Did it happen in the past? This is 1994. Can you see when the recession hits? Well, the stock market is already dropping, went down even further. Okay, same thing, every time there's a recession, stock market's deep. This one is not too bad, it's like a correction, okay, but this one you can see prolonged period of bear market. So what do we do then? You must understand something. When we talk about the stock market going down, we are talking about in general an average of all the stocks. Now, do stock market perform well? Okay, are there stocks that perform well during the recession? That's what I want you to look at in this video. Now, by the way, I want to say that whatever indicators we look at, it is never 100%. But however, if let's say it's a very high percentage, it's almost 100%, yield curve 100%. And every time the Fed cuts interest rate, unemployment goes up, that one is almost 90% of the time. Are you going to ignore them and tell yourself that there's no logic? There may be some correlation. And how does it trigger? We got to look in further. And also, we have counter data. There are also counter data that shows that out of the 14 rate cycles since 1929, 12 of them, each time the rates is being cut, okay, 12 out of 14, the S&P 500 actually increases for the next 12 months. So what we can see is maybe perhaps after the rates have been cut, unemployment rate is going to actually increase based on historical data, but it may not be immediate. There may be a certain time lag. Now, so what do we do now? Is the market going up or is it going to go down? What I'm pretty sure is this: it will either go up or down, but there's a higher chance that there's going to be a recession. So what I did in this video is I want all of us to be prepared, and we want to look at stocks that do well during these recessions. So these are the total returns in percentage by sectors in all the previous recessions. So you can see these are the big recessions, the global financial crisis, 2020 COVID. So you can see there are some sectors that consistently do pretty well or not as bad. The first one is health sector. Can you see the health sector? So even during some of the worst recessions, they are doing a positive number. Except for global financial crisis, none of the sectors had a positive number. It's all down. Okay, so we have to look at the ones that's least affected. Okay, another one that you can take a look at is also those that is not as affected will be consumer defensive. Can you see that? For consumer defensive, generally in the greens, okay, except for these two, but on average, it's not as bad as the rest. So if I go in a bit deeper, this study is done over the past 7 periods of the recessions. You can see this is since 1960s. During recessions, okay, there's always a market cycle. You can see as this graph has shown, they go to the peak, then there's a recession, and then there's a recovery and expansionary. So I think right now, if you are very, very aware of the situation, we are definitely facing a slowdown. It's not expansion. We are not at a recession yet. Some of the economists say we are already in a recession, but either whatever they say, we are somewhere around here. Okay, we have not recovered yet. The Fed is trying to do a soft landing. They're not trying to boost the economy. So we are somewhere around here. So during recession, these are the sectors that will be doing well. You can see that most of them don't do well, except for consumer staples. Well, 1% is not really doing well, but it's not that bad. And you can see on average in the 6 out of 7 recessions, consumer staples, utilities, and healthcare, they outperform the overall market by 10% on average. Now, outperform doesn't mean that they are making money, but they are losing less money. That's how they outperform the rest of the market. So do take note of these 3 sectors: energy, healthcare, utilities, and consumer staples. Take note of these 4. Now, so what I'm going to suggest is this: we may start to shift some of our portfolio focusing on these 4 sectors. A lot of my portfolio is in technology. That's where I may start to think about trimming it down and parking some money over here. Now, another good news is this, okay, because right now, as the interest rate drops, I would say that a lot of the big financial institutes that are focusing on the income fund, they will be shifting their portfolio into stocks that give high dividends. And when we talk about high dividends, these are the stocks that will be giving high dividends. Higher dividends, I would say. Okay, we'll take a look at some of them specifically. Now, so during recession, if it comes, that's where we will have some, I would say, buffer. Okay, we have some, I would say, safety net. When we put our stocks into some of these sectors, that's where we will not see our portfolio drop as much. And at the same time, we can write options, we can get dividends. It's not that bad. And when recession really hits and you see technology dropping by 20%, when you see financials dropping by 13%, that's where we will start to shift our portfolio into technology, into finances. Now, I will avoid real estate for now, because a lot of people say interest rate is going down. That's where I'll put more stocks into real estate. Initially, I thought that way as well. But if a recession really hits, so even if an interest rate goes down, when there's a recession, the real estate sector is going to be hit the worst, you can see. So this is what I will be doing. I may be wrong, but the thing is, I'd rather be safe. Got it? So you can see that during recession, that's where I'll do it. And when recession, I start to put into technology, start to put into finances, and also maybe consumer discretionary. When they start to recover, you can see recovery. That's where technology will be very beneficial. During recession, that's where you can look at real estate. But again, not very keen on real estate because it's highly leveraged. Not very comfortable with that for myself. I can put into finances. So you can see that if they actually lose a lot, when you buy them, the recovery is very high. So why not buy into technology right now? If you buy into technology right now, you may see your portfolio drop by even up to 20%. And when you recover to 28%, you just gain 8%. You see, it's not that huge. Whereas if you put into, let's say, consumer staples, well, during recession, you make about 1%. And when they recover, they make another 18%. So there's a 19% increase. You get it? Whereas technology, minus 20%, goes up by 28%, it's just a 8% increase. So you going for all this, I would say, stronger stocks during recession-proof stocks may give you a better returns. Okay, so this is what I'll be doing. And also you can see for utilities, for energy, plus 27%. Here -4, here +27, you still have a 23% increase. I'll also be looking at some energy stocks. Now, after recovery, that's where we have expansion and slowdown. But I'll not be talking a lot about this. Now, in case you say that the economy is just slowing down, it's not going into a recession, consumer staples will still be a very good bet. Can you see that? It will still be a very good bet. Still about 15%, or healthcare will be about 15%. So these are things that I would suggest maybe you can take a look at. So now, where do we actually find all these stocks? I'm going to give a suggestion, and the suggestion is we can look at a list of dividends aristocrats. These dividends aristocrats are companies which have been giving dividends for the past 25 years consecutively and increasing. And I've already sorted them out by different sectors. You can see these are the sectors that we can be looking at. Consumer defensive. So I've put them into this particular Excel file. Take a look at these companies. Remember to study their fundamentals as well. Don't just throw it and buy and forget about them. But you can see some good fundamental business will be Coca-Cola, Pepsi-Cola. They are slow, they are boring. Well, that's what they are here to do during the recession, to help us boost our portfolio or protect our portfolio. That's why they are defensive kind of stocks. Okay, so you can see a few more things that I look at is this. I've actually put their dividend yield. So out of the consumer defensive, these are the dividend yield. A good idea will be looking at those higher dividend yield with strong fundamentals. So another matrix that I put inside there is the Z-score. The Z-score also tells us which company is fundamentally strong in terms of being able to survive the recession. So anything that's more than 3, it's considered extremely good. Anything that's less than like 3, like 2.75, it is not that bad, but you can see something like 0 point something or 1 point something, they have very high risk of being default or going into, let's say, financial trouble. So you can see some of the insurance company, the financial companies, they have very low Z-score or 0 Z-score, because if recession comes and they do not have enough buffer, they may get wiped out. So do take a look at the Z-score. The Z-score, remember to look at something that's more than 3. So consumer defensive is something that I look at. Another one that we mentioned that we are looking at is healthcare. Okay, so healthcare, this is another sector that we can look at. And in a moment's time, I'll show you where to get all this whole entire list of stocks. And also energy. So for energy, in my opinion, it's pretty interesting right now. Okay, you can see that they have pretty decent dividend yield, about 4 point something percent, 3 point something percent, and their Z-score is also pretty good, more than 3. So Chevron, Exxon, these are the things. So where can you find this? I've already put them into my Telegram group. So in the Telegram group, I've actually placed this into the file, Stocks for Recession. So you can watch this video, look at the list, and we can have more discussion. So where do you find this? Once you join the Telegram group, I'll put the link in the description below. You can go to Files, and it should be somewhere on top here, Dividends Aristocrats. So again, I want to end this session by reminding everybody that sizing is nothing. Okay, sorry, size is nothing. Your portfolio size is nothing if you are not prepared for recession. Sizing is everything. How to allocate our portfolio, how to make sure we invest safe, how to remain psychological resilient, knowing that even if I hold the stocks, well, if it goes down, long run, you'll be okay. And make sure that you don't just depend on one stock. Make sure you do your portfolio. I do that. This video helps. If it does, give me a thumbs up, and also do help me subscribe and also comment in this video. What do you think? I may be wrong, but I think I can sleep better at night having this kind of mentality and this kind of portfolio. All right, I'll see you in the next video. See you soon and invest safe.